NAPEC's doing some work on diversity, equity, and inclusion. So I'm very aware of it when I'm reading whatever I read. There was a small piece in the New York Times this morning in Deal Book that had some very interesting savings rates for minorities, particularly Latinx and Blacks. And I didn't know if you guys were doing anything with financial sustainability or financial literacy, but you might find the facts interesting because over 15% do not have a bank.
I know that that Michelle and some of the groups that she's been working with have had conversations about financial literacy and the need to work on that area. I know that Alec Weil from Bank of America, that is specific to the work he wants to do. So I know that's part of the conversation because, you know, we just recently hired a new policy director. And our focus is really going to be on equity, racial justice, and economic development. So the issues that you're talking about, or this particular issue of financial literacy, is something that will be among the issues they'll be addressing and discussing.
So let me forward this to you because it was a different set of data than I've seen in the past.
Okay.
And then I'd also tell you to go to the NAPEC website. We have a diversity page, and there is an incredible number of resources that we've been accumulating over the last 9 months. And links to other various associations, websites, programs going on, all kinds of stuff. And some
I can help.
Yeah.
Thank you. I think that's great. Yes, please that forward to me, Kit. That'd be great.
I was going to say, Jose, I can help with the financial literacy also, so we can get a lot of information and do presentation on that if you guys need help with.
Outstanding. What I can do,
help because it's part of a community service.
Yeah, what I can do is I can link you. Hi, Michelle, welcome. And the reason I'm glad you're here, Michelle, Kit was mentioning that she came across some articles around financial literacy in the New York Times this morning that she wanted to share with us. Want to mention what that is, Kit, again, just quickly?
Sure. So I've been working on this with the National Association of Estate Planners and Councils for the last 9 months. And we've got a committee dedicated to DEI. And so this morning when I was reading my deal book from the New York Times, there were some interesting statistics for minorities. So I'm going to forward it to Jose, and along with a link to our page for NAPEC that has a ton of resources that we've accumulated over the last 9 months. So you guys don't need to recreate the wheel.
Well, thank you. I was mentioning—
And take what you like.
Yeah, I was mentioning to Kit that, you know, we just hired recently a policy director, and we talked a little bit about some of the focus of that work. So I thought it'd be great to link the two together. Also, Sue Yi indicated the Manufacturers Bank also has a financial literacy program, correct?
Yeah, we can, because it's part of our community service where we can go out to different community and do some presentations. We kind of offer different things, kind of educate them in various different things, how did they apply for loans, or how did they, build up their credit, things like that. We can definitely help.
I'll tell you one place where it's really important is scholarships and financial aid. Families and students entering college. That's where we really see the conversation happening the most. And even more so today, as families feel more vulnerable but want to get their kids to college, and what the debt burdens and different choices, private, public, and how we're looking at some legislation that would change a little bit how colleges are able to displace their award if a student gets a private scholarship. So we struggle with that. So well-meaning person will give someone money, but it will reduce their overall award package. So there's a lot with financial aid. Thank you for elevating that. Thank you, Jose.
So Kit, I would just mention selfishly that a few months ago, I published an article in the UC Davis Law Review that looks at minorities and estate planning, in particular charitable estate planning. Be happy to share that with you as well.
Oh, I would love to see it.
Yes,
And
if you can share that, we can get it to the group as well.
Yeah, if I have a daughter in Sacramento, so when I get up there, we'll need to, you know, at least from a distance, wave from each other.
Well, good morning to everyone. I'm glad you're all able to join us today. It looks like we have a great turnout for the program today. We have a great speaker. For those of you who don't know me, my name is Jose Marquez. I'm the Director of Planned Giving at the Inland Empire Community Foundation. I want to thank you all for joining us today. And I'm going to take the opportunity. Right now we have 24 people. I know we have almost twice as many that registered. So I'm going to take the risk of having everyone briefly introduce themselves, identify your name, title, and organization, because part of this effort really is for people to also connect with each other. So I think we have that opportunity. So I'm looking at the screen. So I'm going to start with Mary Hanson Ferris. Of course, she's muted. Go ahead, Terry, introduce yourself.
I'm Terry Bridges, and I'm a recovering attorney. I practiced in Riverside for 50 years. I was born and raised in Riverside.
And Terry also will be speaking with us today. Joanna?
Joanna Averett. I'm Averett Fiduciary Services in Redlands.
I'm going to introduce you in a few minutes. So I'm just looking at the screen I have in front of me. Charlotte?
Hi, Jose and everybody. I'm Charlotte Volch. I'm a real estate broker specializing in probate and trust in the Inland Empire and the High Desert.
Thank you. Kit?
Gotta find that mute button. My name's Kit McNee. My day job is with Morgan Stanley as a certified financial planner, and I sit on the executive committee for the National Association of Estate Planners and Councils.
Thank you. Paulette?
Good morning, Paulette Brown Hines, Chair of the Board of the Inland Empire Community Foundation. Looking forward to the presentation today.
Joe?
Hello there, Joe Staley, Inland Empire Community Foundation, and I work out in the Coachella Valley. That's regional charitable giving officer.
Paula?
Hello, everyone. I'm Paula Miles, Senior Vice President of Finance and Stewardship for the Foundation.
Neil?
Neil Wayner, Stout Payne Wayner Wealth Management, located here in downtown Redlands.
Robert Fay, Dr. Bob Fay.
Hi, I'm Bob Fay. I live in Palm Springs. I've been here almost all my life. In a small town, you do whatever you have to. I've been a banker, realtor, built homes, CPA. Right now, I'm the chairman of the Neurovitality Center and
Thank you. Sergio?
Hi, good morning. Past chair of the Community Foundation. Glad to see everybody.
Kathleen?
Yes, Kathleen Albrechtson, attorney in Redlands. This is
Are
what
you
I
driving?
look like. This is what I look like when I'm returning from pickleball and headed to the office.
Okay, great. Jolene?
Hi, my name is Jolene Akery, and I'm the Director of Business Development for Home Care Assistance in Riverside, where we are changing the way the world ages by providing in-home care for our seniors. Thank you.
Thank you. Teresa?
Hi, Teresa Ryan, estate planning attorney. I practice in Riverside and Paso Robles, which is where I am right now. And thanks to Prop 19 all over California. That's it.
Maribel?
Hi, everyone. Maribel Cialcita. I'm an attorney, practice in estates, probate, trust, litigation, and elder law, and I'm in the Claremont Village area.
Rosara.
Hello, everyone. Rosara Parsons, Wealth Advisor with Wells Fargo Private Bank. And I am also on the board of Crofton Hills Community College.
Marcia Campbell. You're on mute, Marcia.
Okay, I thought I had unmuted. I'm Marcia Campbell. I'm a CPA. I work, specialize in working with seniors and trusts and working in the court system with court accounting. So thank you for letting me come.
Thank you, Yumeng.
Hi, my name is Umang Patel. I work with Pacific Advisors, and my area of practice is doing a wealth transfer for next generations with taxation in mind, and also helping client understand how to achieve their charitable intentions.
Thank you.
Thank you.
Belmonte.
Hi, can you hear me? Good morning, everyone. James Valmonte. I'm with Cap Trust. Actually logged in early here in Hawaii on spring break with my kids, but when I am working, I'm based out of downtown Riverside.
Thank you. Mr. Sheth.
Yes, I'm with New York Life for the last 30 years, and charitable planning is part of my practice.
Thank you. Rob.
Hello, Rob Bukacek with Pacific Advisors. Sorry for my casual appearance this morning. I'm a financial advisor specializing in business, succession, and exit planning.
You look cool. It's all right. Mary Henson. Okay. Eric?
Yes. Good morning. Eric Post, Pacific Advisors, specializing in business succession, exit, and transition planning. Yeah.
Cherie.
Hi, good morning, everyone. Cherie Gillens, Marketing and Communications Director here at IECF.
Thank you. Gil? Michelle.
Hi, Michelle Decker, President and CEO of the Inland Empire Community Foundation.
Well, thank you all for being here today. And I have the honor of introducing Suyu Chin. We're very pleased to have Manufacturers Bank as a sponsor for this year's Professional Advisor Council meetings. We plan to have 4 this year, and this is the first of 4. So Suyi is the Senior Relations Manager and Team Leader at the bank. So I'm going to turn it over to her to give you a little bit of background about the bank and about herself.
Great, thank you. We really appreciate the opportunity to sponsor this event, and I definitely look forward hearing Dr. Russell's presentation on this CARE Act. I think it's very timely. For some of you, I don't have the pleasure to meet yet. I've met quite a bit of you, I think. My name is Sui Chen. I, like Jose said, I was with Manufacturers Bank. We are primarily a business bank that's been around since 1962. We are focusing helping small to medium-sized business clients grow the business by customize their lending as well as cash management service. But additions, I know we have a lot of attorneys, professional fiduciary, and advisors. We have a very robust trust and estate programs to specialize working with you guys, like in terms of setting up trust accounts, obeys, and block accounts. We can accommodate like our state signer, which is, during COVID, it's like nobody go anywhere, but we can do contactless, especially on co-trustees and also multiple $1 million FDIC insurer accounts. So that kind of help a lot of your clients avoid going bank to bank for the FDIC coverage. So especially on the block account, like for example, if you sell a real estate, all the money need to set up on a block account, $1 million. Typically, they have to go to 4 different banks for that service. But with us, we can set up one account and all your funds are fully FDIC insured. So feel free to give us a call. We're definitely here to service for if you guys have any questions. I'll post my contact information on the chat a little bit. So thank you, Jose.
Thank you very much. I think there may have been 2 people that I missed when we were doing introduction. One is Kim Potter. Kim's critical to this meeting, so I want to make sure I don't miss her.
I am Kim, and I am the executive assistant at Inland Empire Community Foundation.
Joanna, you get a chance to introduce yourself? Okay, for some reason I thought I missed you, so I didn't want to do that. Okay, great. All right, I have the privilege, and thank you, Suyi, and thank you again for all your support. You've been great, to introduce our next presenter, which is a little bit unusual. Usually I take this few minutes of this agenda to talk about the Community Foundation, which actually Michelle will talk about later in the meeting. But we have a special guest that I've invited to come today, and that is Terry Bridges. Terry, I asked him to kind of talk about a little bit about his giving. He has provided a planned gift to the Community Foundation, but I really wanted him to talk about a little bit about him from his perspective, being a donor, why it's important to give. And Terry, as he mentioned, has over 50 years as a trial lawyer in the city and community of Southern California, recently retired, but he's been engaged in mediation for over 25, 30 years. He has been published in numerous journals, including the California Lawyer, which is a litigation publication of the litigation section of the American Bar Association. He has held, or did held for over 45 years, the AV rating by the Martindale Hubble Attorney Rating Service, and was also identified as one of the best lawyers in America from 1993 until the year he retired. He also was recognized for his role in increasing civility, which is interesting, civility in the courtroom and in the legal profession by the San Bernardino Riverside chapter of the American Bar of Trial, Board of Trial Advocates, which presented him with a Civility Award. He was also honored by the Leo A. Duncan Inn of Court, the local chapter of the American Inns of Court, which seeks to improve the professionalism and ethics of those in the legal community. And they honored Mr. Bridges by the establishment of an annual Terry Bridges Outstanding Award, Attorney Award program, which started in 2007. So I feel very privileged that, having the opportunity of working with Terry over the last several years and getting to know him and his family. And I will turn it over to you now, Terry, and I say thank you for participating today.
Thank you, Jose, and thanks everybody. It's an honor to be here and to share my thoughts and my feelings and my goals for planned gifts. I have 2 topics to talk about today. 1, why did I decide to give planned gifts? And 2, why to the Community Foundation? Let me start off with the first. Why did I decide to give planned gifts? I obviously understood at a younger age the benefits, short-term benefits of tax and the long-term benefits of an income stream. I also understood at an early stage that I could maximize and grow my assets by planned giving, and I could also control or modify my use of assets by the proper vehicle. Those were all and are all topics that everyone generally thinks about in planning. But over the years of giving, I found out that my real reason was not just for giving and for tax purposes. And my primary reason for giving turned to a number of different reasons. First of all, I wanted to honor the most important force in my life, my dad. Secondly, I wanted to honor the second most important force in my life, my undergraduate University of Santa Clara. I did so by establishing a series of scholarships for first-generation students And that was a great, great satisfaction for me. I also wanted to give back to my community. As I said, I practiced for 50 years. And my belief is that we have a responsibility, a civic duty to give back to our community. So I wanted to align myself in a manner that would allow me to give back to my community and see the benefits of that. I also believe that an important thing, and one of the key things for me, is to fund a personal cause. As Jose mentioned, I'm very committed to civility in my honored profession and try to impact and encourage changes in civility for the better in the legal profession. And to do that, I was able to fund a program at my alma mater, in which I designed, and which is intended to make sure that every law student at the University of Santa Clara, in every single course, has focus on civility and professionalism. And that was a great, great joy for me. I also want to talk about the most important aspect. It's not talked about very often, but it is sure felt by me. My primary reason for giving is for the joy of giving. I have felt incredibly happy and blessed by the gifts that I have given. It's a wonderful feeling to be able to share the goodness that has come to me in my life with other people and other causes in my life. That's the primary thing, is my joy of giving. Incidentally, there's a reason for giving, and you have probably read and reviewed and at least be aware of the studies that have shown that there is an increased happiness for people who give. Likewise, those same studies show that there is an increase in quality of life and in longevity for people who are involved in philanthropic endeavors. I want also in my gifts not just to give, but to remain involved. And this is one example of the joy of being able to talk to you today about some strong feelings that I have of giving. And you will note that all of those thoughts, all those feelings, all those emotions are way beyond the strategic estate planning aspects and have given me a great, great joy and pride of giving to areas and to beliefs and to commitments in which I believe. The next question was, why did I give to the Community Foundation? I should preface this by saying that I have established CRUTs or CGAs or other forms of charitable giving with a number of other foundations located throughout the state. So I compare the foundation with all of those, and the foundation comes out so far ahead for a number of reasons. First of all, I'm dealing with nice people. Second of all, I'm dealing with people I respect. Thirdly, I'm dealing with people who follow up with me, who treat me as an individual and follow up in a personal manner. I'll say I'm talking to you particularly.
Thank you.
And talk to me personally rather than just by emails, by mailings, and to keep that personal connection going on a regular basis. I've never had that before I came to the foundation. I also have the same people to call. That's very important. You don't get calls from or contacts from or excuses from a number of people. Everyone at the foundation is responsible for their own particular area, and I know who to call, and I know that they will get back to me quickly. That's another reason, the promptness of replies by the foundation. And other foundations with which I've dealt, promptness of a reply is very, very lacking. If I call Jose or if I call anyone, I will get a return call that day. And that's extremely important to me as a giver. Next, I feel appreciated by the foundation. It's a wonderful feeling to know that your gifts are appreciated and appreciated by the foundation that will administer them. It's also important to respect the individuals with whom you deal, and I have profound respect for everyone in the foundation. I appreciate that and I applaud you today. It's also important for me to join the foundation or be involved in the foundation because it benefits my community. As I said, I was raised in Riverside. I was educated from K through 12 in Riverside. I've never forgotten the benefits that Riverside gave to me. And as I said earlier, I consider it to be a civic duty and responsibility for me to give back to the community. And how better to give back than to involve myself with the foundation in my community. I also appreciate the foundation. I remember we've had several conversations, Jose and I and others. This is something that is very lacking in many foundations who are interested primarily, or oftentimes, if you will, in return on investment for them and for their clients. They don't understand, as the foundation does, that a gift should be appreciated not only by the foundation, but by the ultimate beneficiary for the work that went in to get that gift, to generate the funds to give that gift. And if someone is giving $1,000, that $1,000 may mean the world to them. And that is appreciated and understood by the foundation. And we've all heard stories where that gift of $1,000 is sometimes met over the years with much larger gifts because of the way people have been treated. I like the personal touch and the regular contacts that we've had. I've mentioned Jose, we have regular contacts, and I am brought more into the fold of the community foundation with each contact with Jose. How am I doing, Jose? You're going to cut me off?
You're doing fine. I'm looking at you've got about a minute.
All right. I want everybody to take out a pen, piece of paper, and write down that this is the first time in the history of trial lawyer speaking that he finished his remarks within the time allotted. Thank you very much.
Thank you, Terry. I appreciate it. And yes, Terry and I have not only had regular communications, but really have gotten to know each other as, human beings, and having a great relationship and staying in touch with each other. And all of us are in the people business. All of us are working with individuals, whether it's financial planning, insurance, whatever it may be, trust and wills. And we all know the value of relationships. Yes, we can be transactional and try to get, the deal done and make the money. But in the long run, it's really the relationships we build with donors like Terry that really make the difference. So thank you, Terry, for taking the time to honor the foundation. And we really, truly appreciate your gifting and your continued participation and your support of scholarships and educational efforts like AVID in our region. So thank you very much.
Thank you, and I will leave. I have a medical issue with my wife now, so I'm leaving. Thank you.
Thank you, Terry. Next on our agenda, and we're going to move into our presentation. And I'm very excited to introduce our next speaker, Dr. Russell James. Basically, he is the chair professor in the Department of Personal Financial Planning at Texas Tech. He graduated cum laude from the University of Missouri School of Law, where he was a member of the Missouri Law Review and received the United Missouri Bank Award for Outstanding Work and a Gift in Estate Planning. He also holds a PhD in Consumer Economics from the University of Missouri, and his dissertation was on charitable giving. He has published over 150 peer-reviewed scientific journals and been quoted in a number of charitable financial issues in a variety of news sources, including the Wall Street Journal, the New York Times, Bloomberg News, Chronicle Philanthropy. We're just very, very excited to have Dr. Russell James with us today. And if you have any questions, please put them in the chat, and he will respond to your questions either during the presentation or at the end. Okay, so I'm going to turn it over to you, Dr. James.
Okay, great. Thanks so much. Well, if everything's working, you should be seeing the slides. If you're seeing a mess of other stuff, it means I'm sharing the wrong screen, but I think I've got it all set up here. So thanks so much. I'm looking forward to sharing some of these ideas about charitable planning, some that are new, some are new applications of old concepts, and a few other ideas in between. So I teach students occasionally at the law school and graduate students here in financial planning. And when I teach the students, of course, these are my top 10 rules. And I use a face much like the teacher face that you see on this slide. But since you're not my students, I'll just say these are 10 ideas or suggestions. Do with them what you think might be helpful. So what are the top 10 rules? The number one is perhaps the most offensive, and that is never give cash. Now, why would I start out with something like that? Well, it's very simple. We start with this idea. Appreciated asset gifts are objectively cheaper. Now, as many of you probably know, if I write a check, my tax benefit from that is a tax deduction. Maybe I can use it.
Can you hear me?
Maybe I can use it, maybe I can't. But if I make that same gift instead from appreciated assets, I not only get a tax deduction of the same size if I've held the asset for more than 12 months, but I also get to avoid capital gains tax. So very simple concept here. And as this presentation progresses, we'll get progressively more complex, but I want to start out simple, where we've got this reality that the benefits are greater if we give the gift from appreciated assets. So for example, rather than just getting the federal tax benefit, they could be worth up to $37,000 for a $100,000 gift. I also, if I'm giving shares of stock, say that I bought for $10 a share, it's now worth $100 a share. I also get to avoid capital gains taxes worth a bit over $21,000. Now, this is particularly important for non-itemizers who can't use that income tax deduction because, of course, they can still avoid those capital gains taxes. And so whether they are exempted out from that deduction, either because they're not itemizing or because they've already deducted so much from large asset transfers that they have exceeded those income limitations, which have bounced up to 100% this year. Either way, we can still get a greater advantage with these. Now, these asset gifts actually got even cheaper for those in states other than where I'm coming to you from today, which is Texas, because you not only avoid the federal capital gains taxes, but you also avoid the state capital gains taxes by giving those assets. And this is a bigger deal than it was before 2018, because before 2018, we were able to deduct these state capital gains taxes. And now most clients are going to be, they're going to be capped out from that, just from their property taxes and other taxes that will get them to those SALT cap limitations. So that's the first suggestion, is never give cash. And we'll keep it a little bit simple with the second suggestion, which is to use the charitable swap. So the charitable swap is this idea that if you have someone who is getting ready to write that check to charity, what we would tell them is, no, don't use that cash to give to charity. Instead, give the appreciated assets, say the appreciated marketable public securities, to the nonprofit. And instead, we take that cash and we use it to immediately purchase identical replacement shares of those same stocks. So the idea of this is that we actually don't change the portfolio at all. We simply wipe out the capital gain tax. We donate the old shares and along the way, we buy brand new shares. Now, do keep in mind that we don't have to wait to do this. We can do this in the same moment, the same day, at the same time, because the wash sale rule does not apply here. The wash sale rule is only for lost property. which would require us to wait before we repurchased identical shares, but we don't donate lost property. We only give appreciated assets. The lost property, we would sell it, take the tax benefit, and then donate the cash. Of course, this is made much easier now with the use of a donor advised fund, where especially if you're dealing with a small charity that maybe doesn't know how to accept gifts of securities, the medallioning process, all of that hassle. You don't have to worry about that. Simply transfer those assets to the donor advised fund, and then after the sale, you can send checks out from the donor advised fund to the various charities that the client prefers. So that's the second suggestion, the charitable swap. With the third set, we'll get just slightly more complex, where we'll talk about bunching and some other new tricks. Now, one of the things that came up after the 2018 tax law was the advantage of bunching your deductions. And donor advised funds are an ideal instrument to do this because we can select a year that we plan to itemize, make all of the transfers in that particular year into the donor advised fund, take that tax deduction in that year. And then in later years where we don't plan to itemize, we can simply make transfers out of that donor advised fund to the various charities. So that way we bunch all of those deductions into a single year, although the transfers out to the ultimate charity, well, they still stay the same. A few other things that happened along the way that actually made the benefits of giving go up. Even benefits of giving cash have gone up. One of the things to note is that although the 2018 tax law did reduce the tax rates for some folks, it actually increased the tax rates for specific brackets. But the biggest thing that happened in the 2018 tax law was the elimination of the PEAS limitations. Those actually knocked down charitable deductions by up to 80% for high income donors. We don't have to worry about that currently, and so that makes those deductions much more attractive. As I mentioned, we've got higher state tax benefits from giving due to the SALT caps because giving can bring down those state taxes. The income limitations for those charitable deductions were initially raised to 60%. For this year only, they're at 100%, and then presumably will drop back down to 60% next year unless we get some other kinds of legislation in the meantime. And of course, one fairly new concept that we have this year is the $300 per person charitable deduction, above the line charitable deduction for non-itemizers. Now, what's new this year is that that is legitimately $300 per taxpayer, even for married filing jointly, whereas last year it was $300 per tax unit, meaning that married filing jointly only got one of those above the line deductions, not two. However, this year in 2021, married filing jointly will get two. And now to get a little tax wonky, but do keep in mind, this is a powerful planning strategy, and that is for those clients who might happen to be in this environment. In the 2018 tax reform, we had a new deduction, was a 20% deduction for business income. Now that deduction for business income phases out at higher taxable income levels. Now that doesn't seem like something weird. We have all sorts of tax benefits that phase out at different income levels, but it's actually really weird. And how it's weird is this. It's weird because this benefit phases out at different taxable income levels. We have almost nothing in the tax code that does this, but it creates an opportunity for charitable planning. And that's because taxable income is, among other things, what's left over after your charitable deductions. Now, keep this in mind, because if you happen to have a client who has this kind of business income, but has gotten partially or completely phased out of that special 20% deduction because of their higher taxable income levels, they can actually make charitable gifts to a donor advised fund or otherwise that will phase them back into that 20% deduction. It essentially brings back that business income from the dead. And what it does is it gives clients a double benefit, both from the charitable tax deduction itself and from phasing the client back into that 20% deduction. So the third suggestion is to learn bunching and some of these other new tricks. The fourth suggestion is this: to give retirement required minimum distributions first, and then give more retirement funds at death. So the life stages of a retirement account, we have 3 different stages. We've got early distribution before age 59 and a half. That comes with a nice 10% penalty. So we normally don't want to do that unless it's for one of the specific exceptions. We then have regular distribution from age 59 and a half to 72, which does not come with a penalty, but we do have to count that as income if it's coming from a standard account. And then required minimum distribution now starting at age 72. So giving after age 72, we could, of course, we do have to take that money out. If we don't, there's a 50% penalty for not taking out the RMDs, so we don't want to do that. We could take that money and we could turn around and give it to a charity, but that's kind of problematic. There's theoretically possible in a perfect world, those things might offset, but that's really difficult because of all of the other issues. They've got to be itemizing, no income giving limitations, no negative effects from the increased AGI, not in the wrong state, various other issues with that. And so what we prefer to do, if we've got somebody who's reached the age of 70 and a half or older, is to use a qualified charitable distribution. Now, that qualified charitable distribution allows us to directly transfer those funds from the IRA to a charity, and we can do that starting at age 70 and a half. Now, it does count against required minimum distribution, but you don't have to have a required minimum distribution in order to make this transfer. Some notes about these kind of transfers: these must come from IRAs or IRA rollovers only, not from 401ks, 403bs and such. But if you have one of those other accounts, you simply convert those accounts to an IRA rollover, and then you can do the qualified charitable distribution. Now, one quick note about that conversion to an IRA rollover: if in the year in which you make that conversion, you must first pay the required minimum distribution. So it's a good idea, if you've got a client who's going to be making these kinds of gifts, go ahead and make that rollover conversion before they hit age 72, because then they're not going to be hit with that mandatory required minimum distribution in the year of the rollover. We can make these qualified charitable distributions from these accounts at any point from age 70 and a half or older. They do have to go to a regular operating public charity, no donor advised funds, at least not the typical kind, no private foundations, charitable trusts, charitable gift annuities and such. Do keep in mind that these are limited to $100,000. Oftentimes people get confused because there is a tendency to use this in connection with the required minimum distribution. People don't realize that you can actually do these up to $100,000. It's still a great way to make a gift. This is money that's never had income taxes paid on it. And if you transfer it to a charity, it never will have income taxes paid on it. Also, you can do this even before age 72. Once a person hits age 70 and a half or older, you can make this kind of a gift. Just one wonky little side note, there is a way to arrange this where you can make it act a bit like an above the line charitable deduction. What do I mean by that? Well, when we got the new rules that said you can make transfers into an IRA that are deductible at any age, the IRS said, okay, well, we don't want the same person making a transfer into an IRA, deducting that above the line, and then kicking it back out of their IRA with this qualified charitable distribution. So the same person can't do that. However, 2 different people can do that, such as husband and wife, or anybody else who is married or jointly sharing financial resources. You can have one spouse, for example, be the earned income spouse who is making those transfers into an IRA that create an above the line deduction, and the other spouse, if they're 70 and a half or older, can then be making transfers out of their IRA to a charity. So it doesn't change your combined IRA amounts at all, but it still gives you an above the line deduction if you've got someone who has earned income but doesn't actually want to be changing their combined IRA balance. One of the things to keep in mind is that retirement plan assets inherited by non-charitable beneficiaries are reduced by income taxes. Now, this is very important to keep in mind. A lot of people say, oh, I don't have to worry about estate planning taxes because I'm not at those high levels of the exemption amounts. But if you've got an IRA, you've still got to worry about these regardless of your exemption amounts. So let's take a really simple example. Suppose you've got a client who's only got two assets, $1 million IRA and $1 million house. We say, oh, we don't have to worry about estate taxes. And that's true. We don't have to worry about estate taxes, but we do have to worry about income taxes in estate planning. So with that client, suppose they want to leave half to a child and half to a charity. Does it matter which goes where? And the answer is absolutely yes. So let's say we do it wrong and we send the $1 million house to the charity and the $1 million IRA to the child. Well, if that child happens to be at the top federal, and let's go ahead and put them at the top California state income tax level, that $1 million in the IRA, well, we lose more than half of it. It becomes $497,000 after the child pays income taxes. Now with the Secure Act from last year, the child's required to pull that out even faster. They've got to pull it out within 10 years. If we do it the right way, we get a very different result. The IRA goes to the charity. What does the charity get? They get the full $1 million. It's an exempt organization. They don't have to worry about those income taxes. IRD is just the same to them as any other kind of gift. However, the child gets the house and they get that $1 million house. And what is the result? They get to keep the full $1 million. This is a massive, massive difference that just depends upon doing it the right way. And if we've got a client who has charitable interests, the very first asset we want to send to the charity for in an estate plan is that IRA or other qualified plan money. So retirement plan charitable beneficiaries, who works well? A public charity works well. You can also do a private family foundation. Even a charitable remainder trust can be an excellent option. Kit asked this question: can RMDs for inherited IRAs be used for the charitable rollover? Kit, I believe the answer is yes. If you've got a person who is 70 and a half or older, so they've still got to be at that age in order to use that qualified charitable distribution. If they're at 70 and a half and older, then they can do that. That will count against the RMDs. If anybody has any other thoughts or comments on that, feel free and type that into the chat. The problem is that we generally don't have folks inheriting who are old enough to be able to use that. But if you've got somebody who's close, you may want to wait on that distribution until they hit that 70 and a half so that they can make those kinds of transfers. Okay. And let's see. So I guess that might be your question, Kid. Of course, they don't have required minimum distributions until they hit age 72, but you might be thinking about that 10-year in the inherited IRA. Certainly, if they reach 70 and a half or older, we can make those QCDs so that there's nothing left in that inherited IRA, at the end there. Good question. I have to give some more thought to that. We usually don't run into that because we don't get people inheriting it that are age 70 and a half or older to be able to use that, but I could see that being a possibility. And so some things to keep in mind, again, retirement plan charitable beneficiaries. What are some bad retirement plan charitable beneficiaries? Well, number one, we can't use charitable lead trust. Those actually are not exempt entities, so those won't work. And this other one is not something you can't do. It's just, boy, you better do it right. If you're going to name the estate as the beneficiary and put instructions in the estate document itself, you've got to be very careful about the way that those estate documents are phrased. Otherwise, the estate itself is going to end up having to pay those income taxes with income in respect of a decedent. So be careful on that. It's got to be very precisely phrased. Now, I do have to mention something that oftentimes I'll hear someone say about, oh, well, we don't want to put the charity on as a direct beneficiary of an IRA because they're not a designated beneficiary. It could accelerate RMDs for other beneficiaries. This is a trap that is so easy to get out of. It's not even a trap. It's so much not a trap that it's not a concern. So let me run through some of the very simple solutions you can do to avoid any of this concern. Number one, let's just make it very simple. As long as you pay out the charity share before September 30th of the year following the year of the participant's death, this is not a concern. And I can guarantee you, I've worked with hundreds of charities across the country. I've never heard of one that would say, oh, no, we don't want that check. Just hang on to it for a few years before you send it out of the IRA. That's all you've got to do. As long as you pay the charity out their share before September 30th of the year following the year of participant's death, then this isn't an issue at all. If you don't want to do that for some reason, you could go ahead and separate the accounts by the end of the year following the participant's death. That's fine as well. If the spouse is a beneficiary, you could simply roll their share over into a spouse's IRA. And yes, of course, if you wanted to, you could in advance right now while they're alive, separate the IRAs into a 100% charitable beneficiary IRA and a 100% non-charitable beneficiary IRA. Seems a little complicated, but especially if you wanted to very specifically control how much is going to the charity, you could do that in advance as well. I'm just pointing this out because this is an issue that's not an issue, right? This is something we don't need to be worried about because there's so many different ways out of it. The fourth suggestion is to give retirement RMD first and then more at death. The fifth is to take deductions today for transfers to a charity tomorrow. So let me give you a quick example of an underutilized little vehicle that we can do this with, and that is known as the retained life estate or remainder interest deed. So we can do this with a home or farmland, and it gives the right to own a property, typically after life, but it could be after a set time, to a charity. Now, the reason why this is such a big deal is that the size of the deduction that we get is based upon the current Section 7520 interest rate. So just to give you a feel for how massive of an impact the Section 7520 interest rate has on a deduction, let's suppose you have a client, not that old, age 55, wants to leave $1 million of farmland, and this can be a share or a divided interest, whatever it might be. They want to leave it to a charity. Well, if they do that during a high interest rate environment, the deduction may be as low as $122,000. If they had done it a couple months ago, that deduction's worth almost $904,000. And the reason this is so important is we've seen these Section 7520 interest rates, which, by the way, you can use this month's and the prior 2 months rates. They've gone from 0.4%. We've just lost that. You can't use that now. We can still use the 0.6% rate from a couple months ago, but we know the rates, the current rates have now gone up to 0.8%. And so this is sort of a charitable estate planning technique with a deadline because these rates are going up. If we can get the deed recorded, then we can take this deduction immediately. This is a really massive, massive deduction. I just want you to sort of think about how insane that is, that the deduction you get from giving the inheritance rights to charity for an age 55 donor is less than 10% smaller than the deduction you would get from actually giving the charity the land. Crazy, crazy things that are created by our current low interest rate environment. Now, do keep in mind, of course, the reason you get the deduction is you can't change your mind. These are not revocable instruments, and they are those inheritance rights are immediately owned by the charity. What are some other ways we can take an immediate tax deduction for a transfer that doesn't go to the charity for a number of years? Of course, there's the Charitable Remainder Trust. We have a donor who transfers an asset into their Charitable Remainder Trust. They get payments for life, could be multiple lives. Anything left over at the end of life goes to the charity, but we get an immediate tax deduction for that transfer, even though we're still managing those funds if we want and continuing to take payments for for life. Another example of where we might take immediate deductions for transfers that take place in the future is the grantor charitable lead trust. Now, this is not an estate tax planning instrument. This is the income tax planning version of it, also known as the reversionary charitable lead trust. How does that work? The donor takes an asset, they put it into their charitable lead trust. That trust then makes payments to the charity for multiple years, could be 10 or 20 years. The key of this is that the donor gets the asset back. Okay, so whatever's left over at the end, the donor gets it back. Why do we want to do this? We want to do this because right now, today, we immediately get an income tax deduction for, say, all 10 or 20 years worth of those gifts. So the difference between that and a donor advised fund is, of course, with a charitable lead trust, we immediately we not only get that immediate tax deduction, but we get the asset back at the end. A donor advised fund, once you transfer it, you don't get that asset back, right? Now, this is important because once again, the size of the deduction is dependent upon the interest rate that we use. So this is another example of a gift with a deadline because we are leaving that low interest rate environment, and we can currently grab that 0.6% rate from a couple months ago, but we will be soon leaving that behind. Just as a quick example, you can see how in our current low interest rate environment, the deduction from that can be almost double the size of the deduction in a higher interest rate environment. So that's what we like to do with charitable planning. We like to take deductions today for transfers tomorrow. What's the sixth suggestion? The sixth suggestion is to match deductions with Roth conversions. So Roth conversions and charitable planning can work together to match income and deductions. So let's take, for example, a person who decides to do, say, $1 million Roth conversion. Now, Roth conversions can be fantastic planning. They're fantastic planning because if I take that $1 million from a traditional IRA, I roll it over, I convert it into a Roth IRA. Not only is that $1 million tax-free when I take it out in the future, but also all the growth on that $1 million becomes tax-free when I take it out in the future. So this can be great financial planning, but there's a downside. When you make that rollover, it creates a big tax bill. That $1 million of conversion creates $1 million in taxable income. So when we get a big income spike, what do we want? Well, we want some offsetting deductions, right? So where can we find those offsetting deductions? Well, that's what charitable planning is all about. We can put money into a charitable remainder trust. That gives us an immediate deduction. We can put money into a grantor or reversionary charitable lead trust. That pulls all those deductions forward, and we get the asset back in the end. We could do a charitable gift annuity. We could use a donor advised fund, private foundation, or of course, using the retained interest retained life estate, remainder interest deed in farmland or a home. Also, notice one special planning opportunity just for 2021. As you may already know, 2021 allows for 100% of income to be deducted with gifts of cash. Now, this doesn't work with gifts to typical donor advised funds, but let's say you've got a client with financial flexibility who's made a multi-year pledge. Well, if they've got that financial flexibility, you might keep in mind that this idea of if you've made this multi-year pledge and we want to do a Roth conversion, this is a great year to do it where we would go ahead and accelerate that pledge, go ahead and write the check this year to offset that income spike that the Roth conversion might create. By the way, just as a side note, we can also should be able to use this 100% deduction for a gift of cash that funds a charitable gift annuity. If you've got a client doing that, without getting into all the text of the legislation, let me say if you're interested in this, or frankly, if you're interested in any of these sort of charitable planning instruments, if you just connect with me on LinkedIn, I'll send you links to the paper on this particular topic, and actually links to all my presentations, all of my slide sets. Happy to share that with anyone who's interested. But this actually, the 100% deduction, I believe, is not going to work with a charitable remainder trust, but it will work with a charitable gift annuity. The difference there being a charitable gift annuity is not a split interest gift. It's actually just a trade. Here's some cash and here's something back from the charity. That's actually not a split interest gift. It's a bargain sale, whereas the charitable remainder trust is a split interest gift, so it's not a gift of cash. Charitable deductions, of course, can be carried forward with a 5-year carryover. Now, depending upon the type of gift, that's typically going to be limited to 20% of income, or 30%, or 50%, or 60%, or now certain kinds of gifts this year, 100%. But what if we've got the reverse situation? What if we've got someone who makes a gift out of their wealth, but they don't have that much taxable income, right? If I have unused deductions, how can I pull forward income into a current year? That's a client who's in a reverse situation. So what do we deal with that? Clients made too many gifts already. They've gifted it out of assets. They have low reportable income. We can use a Roth conversion. That Roth conversion then pulls that future income, we pull it forward, we immediately recognize that income, and so we can use more of those tax deductions. Now, unfortunately, that 100% limitation is just for gifts that we make this year, not for carryover of cash gifts, but we can still use this to, again, try to offset charitable planning. We can try to offset income and deductions with charitable planning. So that's the 6th suggestion, which is to match deductions with Roth conversions. The 7th suggestion is this, that is to buy life insurance with tax deductions. So keep in mind, as we look at all of these charitable planning devices, whether it's a charitable gift annuity or a gift of a remainder interest in homes or farms, if it's a charitable remainder trust, all of these, they produce amazing tax advantages. They reduce income taxes. They reduce capital gains taxes. They can reduce estate taxes. It's all wonderful, but they also have another effect, which is eventually that money goes to a charity, not to the heirs. So they also reduce the heirs' inheritance. Well, we can help modify that with some life insurance. Life insurance can help diminish that concern. And of course, if we set it up, say, in an ILET for a taxable situation, that life insurance can be made tax-free. So let's look at an example of how some of these numbers might work in an extreme setting. Suppose Priscilla wants to sell $1 million non-income producing zero basis asset, and she then wants to spend the interest income of 5% while leaving the principal for her heirs. Her combined state and federal tax rates, let's put her at just the federal rates here with these different rates, and let's look at some numbers. So let's take a look at the left-hand side. This is the traditional where we just sell the asset and invest it. That $1 million asset, not even considering the state capital gains taxes, but just the federal capital gains taxes, immediately turns it into a $762,000 asset. So because we've got less left over, well, the client on that 5% return is only going to get about $38,000 a year. And then, of course, if this is a taxable estate, that $762,000 then drops to be $457,000 after we pay these estate taxes. But let's look at what happens when we do this creatively using a charitable remainder unitrust and an irrevocable life insurance trust. So that $1 million asset, what do? Well, we transfer it into the charitable remainder trust. That trust sells it. There's zero upfront capital gains taxes because the trust is an exempt entity. So we take that $1 million asset, we sell it, and what do we have left over? The full $1 million. Since we've still got that full $1 million, we can invest it and put it into a trust that pays out 5% a year. Now that's going to pay $50,000 a year annually, but on top of that, we also get a charitable deduction. Depending upon the age of the donor, we're looking at a charitable deduction of, say, about $300,000. It's worth about $111,000 in terms of tax savings. So we can take part of that $111,000 in tax savings, and we can use it to buy a life insurance policy. Not only that, but we can take part of that extra income and use it to continue to fund that life insurance policy. So we can purchase that in using an irrevocable life insurance trust so that we get it out of the estate. And that client, although they're getting $50,000 a year, they're going to use $10,000 of that income towards the life insurance policy. So they end up with essentially about the same level of income. They're getting $40,000 a year that they're using instead of the $38,000 a year in the typical approach. The heirs, they receive about the same. We could adjust these numbers, make the income a little bit lower, and the heirs could get a little bit more. They get about the same because they're getting that that life insurance tax free from the irrevocable life insurance trust policy. And on top of that, we've sort of kept everybody in about the same place. But surprise, surprise, the charity actually gets $1 million gift on top of this because of the asset that they get from the charitable remainder trust. So just a quick example of how we can meet those same income goals. We can even meet those same inheritance goals and magically sort of create that $1 million gift on top of it. Now, you don't have to use a charitable remainder trust. We can use even simpler versions of this. Suppose you've got a client who just has a $100,000 piece of farmland. He wants to use it for the rest of his life, leave it to charity, but he also wants to benefit the heirs. Well, we could go ahead, record that deed where the charity is going to get that piece of farmland, get an immediate tax deduction, and do what? Well, we can take the cash value of that tax deduction and use it to buy some insurance. So that's the 7th suggestion, to buy life insurance with tax deductions. The 8th suggestion is to earn more by avoiding capital gains tax and other taxes. Now, again, one of the things that we like to do, especially with the charitable remainder trust, is, and really any kind of charitable planning, is whenever we've got a client that holds a large, highly appreciated asset, especially if it's something they want to sell, maybe they want to convert it into income producing assets. Again, if we just sell it, we're going to end up with not that much left over because of the capital gains taxes. If we instead transfer it into a charitable remainder trust, we sell it with no upfront capital gains taxes, and we can earn income off of the entire amount. Now, again, if you've got somebody who is in a state tax, has state capital gains taxes, this $1 million asset is going to become even smaller. If they were at top rates, 13.3% in California, could become very small, although that's a fairly rare client that would be in that space. Whereas if we instead put it over into a charitable remainder trust, we get to keep the full asset, a tax deduction of at least $100,000 on top of that. One of the things to keep in mind, and this is the 9th suggestion, is to grow tax-free. What do I mean by growing tax-free? Well, charitable planning creates a number of tax-free growth environments. If we have assets inside, for example, a donor-advised fund, all of that growth occurs tax-free. It still can be assets under management, but it's growing tax-free. Charitable remainder trust. Charitable remainder trust is very much like an IRA. All of the growth that happens inside the charitable remainder trust is tax-free. We don't pay any taxes until we take it out, just like the growth inside a traditional IRA is tax-free, at least until we pull it out. So we've got that opportunity where we can have gains, we can have income, we can have all that growth, but we have growth upon growth happening in a tax-free environment. Charitable remainder trust allows you to do that. Private foundation, much like a donor advised fund, is tax-free, but actually it's just tax limited. With a private foundation, we have to pay a 1.39% excise tax. So very close to tax-free, but not quite tax-free. And of course, no surprise, but if we're growing in a tax-free environment, those assets are going to grow much faster. So there's a number of ways that a charitable remainder trust increases assets. And if you're a financial advisor, it's going to increase assets under management. How does it do that? Well, number one, there's no upfront capital gains tax at the sale. Number two, there is tax deferred growth in the middle as those assets are being invested and returns are coming back. Once again, only the distributions are taxed. On top of that, you also get an immediate income tax deduction. So you're not going to have to write that check to the IRS. Since you're not going to have to write that check to the IRS, that's also going to increase your assets under management. And something else to keep in mind, if you have a charitable remainder trust that then pays to a donor advised fund or a private family foundation, then you can continue to manage those assets in a multi-generational way. So you can continue to manage the donor advised fund or the private foundation even after the life of the person who is the measuring life for the charitable remainder trust. By the way, all of these different tax advantages stacked together led one finance professor to investigate this question. If you have a maximum payout charitable remainder unit trust that is paying out the maximum that it can to the person who sets it up while still being charitable, meaning a 10% the 10% present value going to the charity at the end. If you have appreciated assets, is it a better idea to use a charitable remainder trust than to simply sell the asset and put it in a taxable account? In other words, does the tax benefit from a charitable remainder trust actually outweigh the cost of the charitable transfers? You know, say if you had a client who actually wasn't charitably inclined. So this was the study that took a look at the power of this. They used a Monte Carlo simulation of 3 million retirement lifetimes, looking at a client, an age 60 male and an age 55 female, very different lifespans and very different returns, and then set the retirement spending target. And said, okay, the clients are only going to spend this much, and used an asset with a 20% basis. So what was the finding? Well, the finding was you actually are better off to use a charitable remainder unit trust than to use the direct investment. So let me do a couple of comparisons here to give you an example of this. Now you notice the direct investment is more likely to fail, that is not to reach those income goals than the charitable remainder trust. But there's an even bigger difference here. In the standard approach, failure means you're broke. It means you've run out of money. With the charitable remainder unit trust, you don't ever run out of money. You just get an income that is something less than your target income. But even with that different definition of failure, charitable remainder unit trust was less likely to fail. And so because it was less likely to fail, on average, you had clients ended up with more income. Not only did they end up with more income, but the heirs ended up with more. Now you say, well, how is that possible? A charitable remainder trust doesn't leave anything to the heirs. Well, it's possible because in this case, the clients are just spending their target amount in retirement, and the charitable remainder trust is kicking off a much larger amount. All that extra amount, they simply save, and it goes to the heirs. So one of the other things to keep in mind that is a little known advantage of the charitable remainder unit trust, and it's one of the reasons why, in fact, the deduction for a charitable remainder trust is massively overstated. What do I mean by that? What I mean by that is this. The charitable remainder trust deduction is based upon the idea that the person who sets up the trust is going to live for the actuarially typical lifespan according to the IRS life tables. Okay, that of course is a completely ridiculous assumption. Why is that a completely ridiculous assumption? Well, as we know, if you notice here in this particular study, when they are looking at lifespans, they're not looking at the typical person's lifespan, they're looking at annuity purchasers, right? Sick people don't buy annuities. So charitable remainder annuity trusts aren't set up by people who have a terminal illness, right? So because of that, these people live longer on average than the typical person of their same age group. By the way, there's other reasons they live much longer. Number one, they tend to be wealthier. Wealthy people tend to live longer. Number two, they tend to be charitable. Charitable people tend to live longer. Now, I'll give you just a quick example on this because there was one study done using data from a very large trust management organization that managed lots of charitable remainder trusts to see what is the actual life expectancy difference with a person who actually sets up a charitable remainder trust. And just to kind of give you a quick example of that, for an age 65 female who actually sets up a charitable remainder trust, her actual life expectancy is 10.5 years longer than the IRS tables say because of the wealth, because of the charitable inclination, because of sick people don't buy annuities. All of these reasons create a much longer lifespan. That's why these are actually a much better instrument than the IRS tables would have you believe. And it's also why the deduction is essentially overstated. So the 9th suggestion is to grow tax-free. The 10th suggestion is to maintain wealth over multiple generations. Now, of course, for those who are financial advisors, you know that keeping wealth together for many generations is very difficult. Of course, the government likes to take a big chunk of those assets at every generation. The rest is then divided into smaller pools with different heirs or children. It's divided into smaller pools at each generation with each beneficiary. The government then takes a chunk of all the subsequent earnings. They get a smaller pool, and then every time they earn income, the government takes another chunk. And at some point, you're going to have a greedier spendthrift heir who's going to blow it all. Now, an alternative to that is the donor advised fund or private family foundation that simply holds money and distributes charitable grants. Now, notice the difference in terms of the potential for multi-generational management for wealth management in this case. If we've got an inheritance, these are wealth that becomes fragmented. There's small pools after division across the children, after estate taxes, taxes at each generational amount, taxation on all the earnings in between, and the risk of sort of greedy spendthrift heirs. But what about if instead you send it to a private foundation or a donor advised fund, either directly as part of the estate plan or as the beneficiary of say a charitable remainder trust? Well, number one, you end up with this big pool of money that's not divided at all. There's no estate taxes on it. There's no capital gains taxes on it. There's no income taxes on it, or at most the 1.39% excise tax from private foundations. You also get the family is still in control of where those funds are distributed, or if they're distributed at all with the donor advised fund. And it is something where it is much easier to maintain the role as the advisor for this pool of funds because you don't actually have to have you don't have to be the number one advisor for any particular heir. You just have to be sort of reasonably acceptable to all of those heirs or those who are controlling the private foundation to continue that role of financial management, which is a much easier position to be in. Now, by the way, there are some special advantages with a private foundation that we cannot do with a donor advised fund. So for example, the foundation can hire an insider to perform necessary professional or managerial services if compensation is reasonable. So we can hire family members for investment advice, for legal work, for accounting and tax services, banking, administrative assistance. Also, there are other transfers which are allowed in a private family foundation, which can go to family members. We can have reimbursement of reasonable and necessary expenses such as meals and travel to foundation board meetings for board members, even for junior board members who perform some functions in that role. These are for minors who are not yet on the board. Travel to grantees or potential grantees sites to investigate current or potential awards. So essentially, private foundations allow for unlimited, multi-generational, nearly tax-free control of wealth with ongoing ability to provide insider travel or employment for professional and management services and limiting charitable activities to the founder's desires. Now, in this comparison between donor-advised fund and private foundation, there's some advantages and disadvantages. The donor-advised fund, currently, no minimum payout at all. Private foundation, we've got a 5% minimum payout. Of course, that 5% minimum payout is reduced by any administrative costs that are associated with issuing or investigating those grants. So it's not often necessarily a 5% that actually goes out to other charitable entities. With the donor advised fund, you have minimal setup and administrative expenses, very easy to set up. Used to be a $5,000 minimum with Fidelity. They've now even gotten rid of that minimum. You can set these up even with just a little bit of money. Private foundations do have significant setup and administrative expenses. Donor advised funds, we have expected control of grants, but do keep in mind this is not legal control of grants, whereas with the private foundation, you do have actual legal control of the grants. Donor advised fund, investment management is allowed with many donor advised funds, but of course it is always allowed with the private foundation. There is some question about the donor advised funds. They are certainly legislatively newer. There is some concern that there may be some legislative changes to those rules, but hopefully we would be grandfathered in on those, whereas maybe the private family foundation is a bit more legislatively stable. Those rules have been in place for many, many decades. And of course, family members can be employed by or reimbursed by the foundation, which certainly is not the case with a donor advised fund. So need to keep that in mind. Question, how does an advisor manage the donor advised fund if it is at a community foundation? The assets are transferred to the community foundation. The donor can only recommend grants and the funds are no longer managed by the advisors. What can an advisor do? Depends on the community foundation. Lots of community foundations do allow for the donor to recommend an advisor if the account gets large enough, but not universal. Certainly is universal with, say, the financial institutions like Fidelity, Schwab, Vanguard, where you can recommend the advisor, and the advisor who manages those funds can continue to be compensated. So so this is one of those things that is different depending upon what is offered by a particular community foundation. And thanks for the comment there. It looks like for your community foundation, it is a $500,000 minimum. So with the $500,000 minimum, then you can go ahead and pick so the advisor doesn't lose out on being able to manage those funds in that particular case. So excellent point to bring up there. Some other things to keep in mind. One of them is in just our last few minutes here, and I'm going ahead and using my 60 minutes. I hope that's okay. If you want me to end shorter, I can. The non-grantor charitable lead trust. Now, I talked about the income tax planning version. This is the estate tax planning version, and the difference is here, we take the asset, we put it into the trust basket, it pays to the charity for a number of years, and then whatever's left over goes to the heirs. Now, why do we do that? Very simply, this is just a tax avoidance mechanism. We do this to avoid gift and estate taxes. How does this avoid gift and estate taxes? Very straightforward. We pay gift taxes on the present value of the amount projected to go to the heirs. We pay no taxes on the amount that actually ends up going to the heirs. So how do we save money with this? Well, very straightforward. If the actual amount left over for the heirs is higher than the projected amount, that part goes to the heirs completely tax-free. Now, here's the kicker. The projected remainder assumes that the investment will grow at the initial 75/20 rate for the life of that charitable lead trust. If the actual growth of assets is greater than that initial 75/20 rate, all that extra growth goes to the heirs tax-free. Now, I want you to wrap your mind around how powerful that is, because right now this month, if you set one of these up, it assumes that for the life of that trust is going to grow at 0.6% every year for 20 years. If you can beat 0.6%, all of that goes to the heirs tax-free. What does that look like? Well, here, using the rate from a month that we could have used a little over a month ago, if you take $10 million, you put it into one of these trust baskets, and you say, we're going to pay out $520,000 to charity every year for 20 years. What is projected to be left over at the end of those 20 years for the heirs? $0. So what do you pay in gift taxes to make this transfer into the trust basket? $0. Now, if instead of growing at that 0.4% rate, you were able to grow the assets at, say, an 8% rate, what's going to be left over for the heirs? $23 million. And that all goes completely estate and gift tax free. So the thing to keep in mind here is that if you use, this is called a zeroed out CLAT, where we're projecting nothing is going to be left over for the heirs at the end, this is a gamble that has no downside. You're gambling that you're going to be able to beat this Section 75/20 rate, which would currently be 0.6%. But suppose you don't. So if you don't, you're projecting nothing's going to be left over for the heirs. If you do less than 0.6%, nothing's going to be left over for the heirs. So there's essentially no downside. You can think of it this way. If the charitable gift or bequest was already planned, if you were already going to be making these kinds of gifts, a zeroed out CLAT, or if it's a gift in an estate plan, a zeroed out testamentary CLAT, these provide a no cost chance at tax-free transfers to family members. Well, folks, if you gave me an extra hour or an extra semester, I would love to talk about all these crazy complicated things we can get into with lifetime and testamentary transfers, like a spigot trust paying for life and then to a family foundation, zeroed out CLATs, testamentary CRTs, income to the kids, and then going to a private foundation ran by the grandkids, and all sorts of other crazy stuff you can do. But I am just about out of time, so I'll go ahead and end it there and see if we have any additional comments, questions, objections, snide remarks, whatever comes to mind.
Are there any questions for Dr.?
And feel free to just unmute yourself at this point. You don't have to type furiously if you have any other thoughts or comments.
Yeah, I have a quick question. Great presentation, by the way. When you're comparing a charitable remainder trust, a donor advised fund to a private foundation, what's that number that you like to see before they're even considering a private foundation?
Yeah, I think $1 million. You know, if we're for a transfer, you know, I'd like to see that for a private foundation. I know some will go lower, but I think just with the administrative hassle and you know, the benefits and that sort of thing, I think that I think you wouldn't want to go below that. But then again, it depends on You know, it depends on the donor, what their plans are, how important it is for them to have control. Because a private foundation, especially if it's part of their estate plan, if they are very adamant on, hey, I want this to be permanent and I want it to be used only for, you know, sick cats in the Bay Area or whatever it might be, donor advised fund can't give you that. Typically. Now, of course, there are some cause-specific donor advised funds, some things you can do. So, you know, if you're going to get below that $1 million level in terms of the transfer, I think you definitely want to have a client who's very motivated by the control, the actual legal, multi-generational sort of permanent control that that a private foundation can give you. You know, and again, it comes back to the rules, because in many cases the local community foundation could do so many things that are very similar to a private foundation, and so you want to explore those options as well. And as with everything, it's just a matter of seeing what's important to the client and seeing how much hassle that they're willing to deal with to execute the different parts of their plan. I don't know if that answers your question or not.
Thank you.
Okay.
This is Kat. Thank you very much. This is a great presentation. Is there any way we could get a copy of the slides?
Oh, absolutely. So happy to share all of my stuff. I think I've already sent that in, but if you just click on the, if you can send me an email, but it's easier if you're on LinkedIn to connect with me. You know, if you think I'm a stalker, then you could just, I guess, send me a note or whatever. And what I will do is I will send you a link to every slide set I've ever done, including this one. You know, so every presentation, I've got, actually, there's a series of 65 short animated videos on YouTube that go through all of planned giving that I've put together. I'll send you a link to all those videos. I'll send you free digital copies of my book on charitable planning, and as well as, you know, links to essentially everything else I've ever done. So it's all free. You know, I'm just a professor. I just like to get the information out there and share it. So if you do connect with me on LinkedIn, I'll send that to you automatically, or you could email me here at Texas Tech, and I can send it to you that way as well.
Thank you so much.
Thank you. It was a great presentation, and we do have today's presentation that he sent to us, so we can also make that available to the group. I do want to take a few minutes to thank Dr. James again. Great job. I really, very thought-provoking, believe me. You know, as you know, we do offer donor advised funds, but that's a whole other discussion. But I do want to introduce Michelle Decker, who's our president CEO. Give her a few minutes to give an update on the Community Foundation. Michelle?
Jose, we are at 3 minutes still, so I didn't expect to take up this time, but thank you to our presenters. Thank you especially to Terry, although he's not here. I think the only thing to mention is that we're paying a good bit of attention to policy right now in the state of California. I would say that the regulatory environment and the policy environment for both private foundations, donor advised funds, and other forms of charitable giving, it's actually pretty fluid. And I think that things that we might have thought were stable for the last couple of decades might be a little less stable going forward, including how you can use that 5% payout, whether you can pay family members in a private family foundation. We just filled out a big survey for the Attorney General's office on donor advised funds within the community foundation. So anyway, lots going on there, but thank you so much for all of that. And then the final thing would just be to elevate our own capacity growth. In 2021, we're investing significantly in our own technology platforms to better integrate the donor experience with our data and use of data and financial management and fund management. So we're going to be able to roll out more later. And we're also beginning to work with a consultant from LA to help us really figure out all of those wonderful things that Terry talked about, all of the amazing things about why people come and work with the Inland Empire Community Foundation. We want to make sure we can do that as we grow. And so we have 20 Terry Bridges that we're able to manage with Charitable Remainder Trust. And so that's a lot of the work that we're doing in 2021, and we'll share more of that with you, but please stay in touch. Thank you for your partnership. We're already off to a great start in 2021. And thank you, Jose, to the IECF team, and to my board member, my board chair, Paulette, and for being here, my former board chair, Sergio, for joining us today. Thank you.
Well, thank you very much. And again, part of the reason we do the Professional Advisors Council is not only for people to network with each other, but really learn about what the Community Foundation is doing. And as you know, if you have questions or have donors interested in charitable gifting or looking at estate planning or doing some kind of a planned gift, please have them contact me or the foundation, and we can work with you. And I've worked with many of you on gifts in the past. One thing I do want to say is that Kim, I think, is going to make available to you a survey, a quick survey to kind of get a sense from you how you felt about the presentation today. Is that true, Kim? There it is. Okay, so if you can complete that, would really help us kind of think about how we're doing in regards to presentation. We do plan to do another PAC meeting in the end of June, so you'll be notified for that. And I just want to say thank you all for joining, and Dr. James, outstanding presentation. I really enjoyed it. And what's great about him, and I've met him on several occasions in the past, is he's unselfish. He's willing to share everything he has, and just like the presentation today, there's a lot of information. So thank you very much, and just want to say thank you. And please fill out the survey, and look forward to seeing you in the near future. Hope to see all of you eventually in person. Take care. Bye-bye.